Beating a market benchmark like the S&P 500 can be difficult, especially for investors who don't have the time to track all the ups and downs of the market. That's where high-performing mutual funds come in. These investment vehicles run by professional stock pickers can be a prudent option for long-term investors. But with over 7,500 mutual funds to choose from, how can investors find the right ones for their financial objectives? On this IBD Explains, we break down IBD's 2024 best mutual funds and how they offer investors benchmark beating returns. Here with me to break things down is IBD's personal finance and management editor, Matt Krantz. So, Matt, what was the big takeaway in this year's IBD Best Mutual Funds report?
Yeah, if you have trouble beating the market, don't beat yourself up. It's really hard. Even the professionals who run trillions of dollars in mutual fund money have a really tough time beating the major market indexes like the S&P 500. It's just not easy to find better stocks that are already in the index.
Can you talk a little bit about the market conditions that are shaping fund performance this year?
Absolutely. So we've seen a real concentration in the market in just a few names. That was especially the case last year. We call them the Magnificent Seven, or you can just call them the Grade Eight or the whatever, the Final Four. But basically, the very top, the most large US companies, mostly tech, really drove a bulk of the market. So that means a couple things. If you own the S&P 500, you own them all already. So if you're trying to beat that, it's even harder. Plus, the indexes are market cap weighted, so these huge companies have a huge influence. So if you didn't own one of the Magnificent Seven last year, you really felt it, and it was hard to catch up. And at the same time, if you're a professional money manager at a mutual fund, if you decide to, go a different route or not own one of these stocks, you really paid the price, and it was really hard for a lot of managers to keep up with the index.
Now, you mentioned the Magnificent Seven. Should this narrow market leadership give investors and fund managers some pause?
Yeah, I've thought about that a lot, and I think a lot of people are concerned. And I think we do talk to some mutual fund managers who are a little bit concerned about it. With that said, we've seen greater concentrations in the past. In the 50s, for example, with the Nifty 50, we saw greater concentrations. And we've seen what happens with indexes, which is so amazing. So everyone was worried last year, what happens if Apple crashes? What happens if Apple goes down? Last year, Apple was the number one stock in the S&P 500, and it was really tough for mutual funds to beat without it. Well, guess what? This year it's down about 10%, and we're hitting all-time highs. Why? Because the S&P 500 is not stagnant. It changes. In fact, we just saw the addition of super microcomputer to the S&P 500. So that's another reason why it's really difficult for the money managers of mutual funds to beat it, because it doesn't stay still either. And they're always adding companies that are outperforming and taking out companies that aren't. So in a way, there is kind of a component that makes that even trickier to beat.
When it comes to mutual funds, there's a lot of options out there for investors. So, what traits did the best performing funds have in common, according to IBD research?
Yeah, last year there was a definite reason for outperformance, and that was focus on big growth. Most of the funds that outperformed focused solely on the biggest of the big companies, mostly in tech, that had a lot of momentum behind them, and that really paid off. We didn't see a single value fund make the list. That tells you how tough it is to beat with value stocks. I think that was a key part of outperforming. Some funds do beat the market. We've got a few. It's about less than 1% of the total universe of US diversified stocks. It's more common in the bond universe for the mutual funds to outperform. It's a little bit of an easier target to beat, but it is possible.
So, when it comes to mutual funds, how can you manage risk?
You know, that's a great question. A couple of things you can think about is usually with mutual funds, you kind of put them away and forget about them. You check in on them every once in a while. You make sure they're top rated funds, which you can do by consulting with our list. And then you just kind of let them do their thing. I mean, if you're constantly trading in and out of these mutual funds, you're probably going to do even worse, because most of these managers have strategies that kind of extend multiple years, and it takes a couple of years for their strategies to kind of come to fruition. With that said, if you've got dogs and you've got mutual funds that haven't done anything in 10, 15, 20 years, obviously it's time to kind of cut bait and see where you can do a little bit better.
So, Matt, how can investors use the best mutual funds list and how does it fit into an overall portfolio?
Yeah, that's a great question. I think a lot of mutual fund investors use their 401ks to do mutual fund investing. So it's a good place to start, get a copy of our best mutual funds and see if any of them are in your menu of selections in your 401k or your IRA. And those are definitely worth your time. There are some funds that do outperform the market, and when they outperform, it does make a big difference over a long period of time. With that said, if you have a bunch of funds that aren't beating the market, you might want to consult with our best index fund list and see what you've got there, or just get an S&P 500 fund and know that you're probably beating 90% of all the mutual funds out there anyway.
Well, Matt, thank you so much for your time today. We appreciate it.
Thanks for having me.